Hello and welcome to Trading the Trend. The question we ask ourselves every Thursday, as JP already announced, what trends are you riding today? And maybe what trends have you been riding? You like the trends you're riding? Would you consider changing? That's kind of the questions we want to ask ourselves here. Maybe are there some stronger trends? Okay. If you have a set amount of capital, you might want to consider trying to put that capital to work where there is potentially stronger trends where you want to invest. We'll talk about that here today. We also got Connie Hill in the chat. We welcome her, and we also like to welcome all of you, Bill, Sharon, Will, Randy, Robert, JP. Her name was Lola. Love that. Dom, and many others. Welcome to all. Now just remember that Connie and myself, we do post educational content on X. There's my handle at the bottom left, and also announcements as well. So check that out. Real quick as we get going here, quick reminders that with what we discuss, we'll talk about stocks and we will talk about options. When we talk about options, remember that options carry a high level of risk and are not suitable for all investors. Understand that you get to pick the strategy, and the information I provide here today is provided for general informational purposes only. When we also talk about examples, we will do those on the Paper Money software application. If you're not using Paper Money, download it, okay? And that way you can get some practice and see if it's a strategy or strategies or that you might consider. Also remember that investing has risk. Without risk, there's no reward, okay? So that kind of goes hand in hand there. And also remember that short options can be assigned anytime up to expiration, regardless of the end of the money amount, okay? And also remember when we talk about probability analysis, theoretical in nature, not guaranteed. And also remember that if we talk about futures, let's say in terms of gold or silver or copper or whatever, we're not trading futures. We're just looking at the futures price that then could have an effect on an industry group, a sector, and or stock. Also, we're not, if I pull up, let's say the euro, the Swiss franc or whatever, the yen, we're not futures trade. We're not doing Forex trading. We're just looking at the currency price, which might also influence what equity markets are doing, okay? By the way, it's kind of interesting to take a look at, as we'll see in just a sec. Now, also remember with what we discussed here, we'll take a look at the indexes real quick, and I want to kind of talk about sometimes what I used to think in periods of markets like we've had. And you might say, James, I relate to that, okay? And so we'll look at indexes first. We'll talk about some of the futures prices we see, and then we'll also talk about really some of the sectors, which ones are getting the push, and then we're going to look at past trades and new trade examples. Now, let's just take a quick look at just real quick. I'm going to pull up, if you don't mind, just quick. Let's go to the index list. Now, remember, this list right here is a list that I made, okay? I can't share the list with you. You could actually take those ticker symbols, and you could make a list. Now, if you take a look at this, I want you to kind of notice what kind of stands out. First off, if we're talking about actual cash indexes, you got the Dow 120, about a 0.25%, S&P about 0.5%, about 38 points or so. You're seeing that the S&P, actually NASDAQ, up 200, 0.8%, and the Russell 24, it's about 1%. Now, if we go back and kind of say, like, in terms of what type of daily trends do we have real quick, after having trend 5 and 1, okay, we've actually had a lot of 4 and 5 and 1s lately. Dow is showing 3, 3, 3. The only one that's really showing 4 is you're going to see the Russell, okay? Now, you want to kind of take that with a grain of salt a little bit, because especially if you're kind of sitting in a sideways range, right? You can kind of go back and forth between those numbers of 4, 5, 1, 2, 3, etc. quite quickly, as we'll see here in just a sec. Now, if we pull these up, and let's do this, let's go to the SPX first. Now, I remember historically, okay, so I started investing in 1996, probably in about June, summer of 96. And I remember, now back then, you just, the trends were pretty much bombs away to the upside. At least that's what it felt like. And so I remember it was probably like, I don't know, 5 years later, the indexes were going sideways, kind of like they are now in the shorter term. I remember feeling like such a loser. That's what I felt like. Because I was like, hey, I'm bullish in terms of those trades, but the trend is a little bit more sideways. Now, let's put yourself in Warren Buffett's shoes. let's say you have $10 billion and you're long Wells Fargo, you're long Geico, you're long American Express and so on. They're not breaking down, but they're more sideways. Does that mean that someone like Warren Buffett has bad positions? No. Just kind of means that the trend is a little bit more what? Sideways. Now, I know this kind of blows our mind a little bit because as technicians, we want either the trend to go bombs away to the upside, crash higher, or go down. This is where we tend to have happiness, right? This is where we tend to have happiness. And if you're long and it goes down, this is where you're sad. But this up, down, up, down, up, down, up, down, it's almost like watching tennis at Wimbledon. Not a recommendation for Wimbledon, but my gosh, if you set your eyes on that, you would enjoy that sideways action. Now, if we take a look at this, now what we've been kind of grinding through is kind of this large red candle and coming back. And all those days, all of them, we've kind of been inside that large red candle. Now, we clearly, as we stated before, we want to get a close above 67.39. But if you look in the shorter term, it kind of looks like we're trying to just make it like a shorter term ascending triangle. Now, many technicians, they love price patterns when it finally breaks out. But this back and forth seesaw, it's like, look, wake me up when September ends, right? So the biggest thing is, this is why there's different strategies, because not all strategies are bombs away to the upside or bombs away to the downside. This is why we talk about theta, because sometimes the only constant is sideways / time decay. Now, this kind of exposes if you kind of feel like you're just emotionally up, down, up, like really high, really low, what type of strategies are you using? Maybe you're going too bullish strategies, okay? Maybe you're picking to stock, and they're not moving as strong as you want them to in the short term. And then you're kind of maybe not considering other strategies that might be more suitable for you given the trend. Now, get off the soapbox here. If you actually take a look at, let's say, the Dow Jones, Dow 2 days ago hit a high. Could we be making a higher low? No, not bad. I would actually say one thing on the Dow Jones. You really actually had higher lows, lower highs. Could this really be the breakout there? Could this really be the high? It was. Could this really just be the higher low that we're building? Yes. Dow Jones has really not done that bad if we're talking about just which index is standing out. Super quick, the NASDAQ here. That NASDAQ, if you pull that back, it never has had a close. I'm talking about the open and close, okay, where the body of the candle is above 25,124. And what you're going to notice is it looks very much like the Dow Jones, okay? There's the breakout. Breakout, the high was actually that day. But if you look at the NASDAQ, if this is really the breakout level, we're still actually holding above it. Clearly, we want 24,780 to hold, okay? So when we talk about indexes, they really don't look that bad, okay? Now, what sectors to you stand out? Is there anything that you're watching? Trust me, whatever you tell JB, I'm not going to tell anyone. The only one I talk to is Jackson, my wife, and a couple kids I got. Okay, so nothing, I'm not going to share it with anybody. If you share it to me, it's good as kept secret. Now, here's the deal. I want to just kind of show a couple things that were kind of standing out. The last 2 days, we've actually seen crude oil have a pretty big push. Now, obviously, if we see crude oil going to the upside, the energy sector / stocks might get a push to the upside. There's a correlation there. If we pull up the IXE, you're going to see that we kind of yo-yoed between, let's say, support and resistance. So in the last 2 days, we've kind of bounced to the upside, and crude oil, after touching, let's say, 56-ish, someone said, look, it's too low, I want to buy some. And someone did, okay? Now, that also kind of plays in the airline stocks, and we'll see that in just a second. If we actually took a quick look at the VIX, okay, now remember, I like to look at the VIX if we're talking about U.S. equity markets. I like to look at the Japanese yen if we're talking about international markets. And if you actually talk about, let's say, the VIX, remember, what's the favorite color for the VIX? Red shading, please. I said please, okay? Remember, the way I think about the VIX is this is like the height of the waves. If we have big waves, man, it's gonna be choppy. Okay. If we actually have low VIX levels, the lake, the ocean, etc., it's like glass. And so wanting that VIX to stay low. Super quick, when we actually go back, a question was asked me, why have we not been really bearish on the market outside your two positions on CSX and Starbucks? Easy answer. Japanese yen hasn't been moving to the upside. It's been, at best, flat most of the time lately in the last couple of months. Why have you not talked about bearish as much? Because the VIX hasn't been bearish, and neither actually has the Japanese yen. Okay? Now, if we go back and look at two things that we want to just point out before we look at our examples, gold has gone maybe on sale. Okay, now we talked about this last week. Okay, we talked about the ATR percentage. There was a question regarding the ATR percentage. I don't have the ATR percentage on this computer. When I grab that, I will share that on my X feed. We kind of talked about as that gets higher and higher, there becomes a greater statistical chance to come down. I want to pull up gold for just a second. And if we pull up, let's say, gold on the daily chart, this is looking at the daily. So we have not been below, remember that blue line, what is that? That is your 10-period exponential moving average. Okay? Now that 10-period exponential moving average, man, we haven't even been below it. We've touched it for a second. This is the first time we've actually seen any closes below the 10. Why is the color of the candle purple? Well, color of the candle is purple because you're below the 10-period moving average, but you're above the 30. So remember, which ones are more severe pullbacks? Well, purple is more severe than orange. Orange is only a sideways consolidation. Orange does not get down below the 10-period moving average. Now, we know there's some investors, they don't like to buy at brand new highs, it just goes against kind of the mentality. They might like it if we get a little bit closer to the 30-period moving average. So you have to understand that sometimes these shorter-term sell-offs, they're just that. They're shorter-term sell-offs. And it's where investors ka-ching, 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 profit take, and hopefully they profit take down to the point where that 30-period moving average can come up underneath it, and where some investors might try to step in to buy. Now, do they wait until it goes exactly to the 30 period? Well, we know it's a potential support area. So if we said, well, what's 1% off that? 1% off that's right at about 4,000 per ounce. If we said, well, I like 2%, I'm willing to buy up to 2%. Well, that's going to give us 40.38. And if we said up to 3% off that, that's the highest. Maybe an investor says it's going to be right at 40.80. Now, remember, what they do is they start to set buy limit orders, right? And so these markers, 4,000, 40, 35-ish, 40, 40, 48, 40, 80 or so, it wouldn't be unfathomable to think that maybe some investors who've been waiting for a little dip, come on down. Some people try to start to cherry pick a little bit and maybe try to establish a position. Dollar cost averaging. Now, that same thing, if we look at this before we look at our first example, same thing with actually silver, which we have not touched a 30-period moving average on silver, high-ho silver. My gosh, what's a high-ho? Since August 20th. Okay. Now, if you like to kind of, for example, look for trends, but they A, have made a higher high, 2, they've guessed the moving average, the 30 period in this case, well, it's silver. Okay. Now, James, I thought you were just talking about kind of these precious metals maybe falling down. Well, they did, but notice how quick the fall down was. Okay. That fall down just in a period of a couple of days, it did. It went down over 10%. Okay. So sometimes that quick snap down can happen quite quickly. Okay. Now, are there any questions? Now, Bill actually says, I'm waiting for a green 10 hull. Okay, let's go back to the chart. Let's go back to that first chart. Let's actually, now, by the way, speaking of this real quick, let's start with just really quick the NEM. Okay. Now, in our example, we have a 10, okay? You'll see it right there. There's 10, and you'll see it right there. There's 20, okay? We have a 10-20 moving average, a whole moving average. And if we look at, let's say, Newmont Mining, and we've talked about this, how we collared the position, the price broke down. We talked about that on Tuesday. And, you know, if we're kind of looking at this and saying, is the sell-off done? Well, we got a pretty good start. It's not quite a piercing line, bullish candle though. And if you take a look at that, the nice push to the upside, trying to get above the 10-period moving average. If we go back to NEM for just a second, you're also going to see that NEM on a standard 30-period moving average, it just, I mean, look how many times we've got some bounces. It went below there, bounced, support area, build over time, didn't pull back to that level, didn't pull back to that level, didn't pull back to that level. So would it be a shocker to see that some investors start to step in? Probably not. Speaking of that, okay? Now let's go back to an example. Now, one of the questions I get a lot is, hey, you know, when would you consider taking that call off? Okay, or if you had a caller, let's go back and look at this position first off, okay? So we have 100 shares of stock, and the paper money account has been weathering a sell-off, okay? And, you know, which side of this trade is the most hit? It's the side of the trade that's bullish. How do you know it's bullish? Well, shares are bullish, and you have a positive delta. And as the stock went down, it got hurt. Now, this is kind of interesting because what you're now going to notice, it was hurt, and now the profit loss is back positive. You kind of see that theme that a lot of times they go down and bounce back up, okay? It just a lot of times that's what happens with volatility. It's like rain or a hurricane or a tornado. It doesn't stay there for 30 straight days, typically. It just kind of smashes down and then tends to bounce back a lot of the times. Not all, but a lot of the times. Now, the question is, which side of the trade is bearish? Well, your short call is bearish. You want the stock to stay at or below that strike. And you actually got, in this case, the 85 put, which is the long put, which is the right to sell the shares at the strike price from now to expiration. However, what side of the trade is the most bearish? Well, if we're talking about something that's the most protected, it's the pet, okay? Now, what I want to kind of submit to you is, when would the investor buy the call back? Or maybe even buy the call back and sell the put? When would they consider on doing that? Well, let's go back to this chart for just a second. If we go back to this chart and said, okay, let's go back to the question, the comment that was said before, I'm waiting for the green line on the moving average. Do we have the green line on the moving average? No. So are we going to buy the call back yet? No. We going to sell the put yet? No. Do we know if this candle, this price starts to get above the 10-period moving average, is there a greater likelihood that, for example, in this case, that we could exit the protection? So when I say exit the protection, I'm talking about buy the call back and sell the put. Okay? Now, we got earnings. When's the earnings? Oh, they're today. So why are we not going to get out? Number one, because we got the protection over the earnings. We want to protect the shares just in case. And by the way, if you did not see the IBM gap down, hello, I don't even know if this is a misprint. I'd have to go back and double check on the intraday chart. But sometimes on earnings, you can just get a crazy reaction. Feels bad for the people that were stopped out, okay? The advantage of a put over a stop is if it goes down to that price or less, it could trigger to sell. If someone just had a protection over the earnings, just because the stock went down doesn't mean they actually got out. They just have the defined protection of the long put. That's a huge difference, okay? Now, if I went back, so on NEM itself, what we're not going to do is we're not going to, in this case, exit the protection, okay? We got to get through the earnings. We want to see this get through the earnings and at least get 3 days past the earnings, 3 trading days, and make sure that we don't have an earnings reaction and the stock is starting to really get above that shorter term moving average. Okay? Yeah, that was crazy, Kevin. I know. Now, what I want to do is I want to kind of talk about just real quick AEM. Now, AEM is going to be in the same situation. It's going to be on the 30th. So we're inside a week now, okay? The other one, silver-wise, gosh dang it, what was that name? WPM? Yeah, there it is. Now, Wheaton Precious Metals. Now, here's the deal. The earnings on this one is about 11 days. It's on 11/6. Now, how many of you, when the stock goes down, do you just like to try to get in on the dip? Dog, just tell me who you are. How many of you like to say, James, if this drops, this is where I like to come in? Okay, now, remember we talked about before gap downs? So let's take a little open book quiz here, okay? What was the resistance on this chart on the gap down? Can you explain that to me? On our first trade example, where's the resistance on this chart? Okay, well, on a red candle, if we gap down and the candle's red, the resistance is the open of the red candle. Okay, now, if the price stays below that resistance, sellers are still in control. If the price starts to get above 99, 98, 96, all of a sudden, whoever has been bearish might look to start to cover their positions, and or whoever is looking to get in, okay, they actually, now, I've kind of heard beep, beep. Now, sometimes people will say language like, man, if it drops down here, they would back the truck up and get in. I don't know what that means. When people say that, I'm kind of always like, what do you mean by beep, beep? Okay, now, let's kind of show this example. Now, we know that if that stock goes down like that, the volatility might be a little high. Now, I'm not saying it's the highest it's ever been, but lately, we have also seen in this case, hey, look, we're at 32, 34, 36. We're up here at 46, okay, in the shorter term. If I back this off for the year, it's not the highest. The highest volatility we actually had was back in April 7th. And I know that's where a lot of people were like, my gosh, you know, you look back and say, I would have loved to sell some puts right then. Okay, well, we're not there. We're here, okay? We have something pretty similar, though, okay? That implied volatility is 52. Now, remember, high implied volatility, big premiums. Big premiums, lower break even. Lower break even, a greater statistical chance to be above the break even price at expiration. Say that 10 times. Now, what we're going to do is, first trade example, we're going to come into WPM. Now, why are you not choosing NEM? Why are you not choosing it? You got earnings, we're inside the week. The WPM, it just has a little bit more time. And the thing is, we're going to try to use that volatility to sell something, okay? Now, if we were to look at this, look and see where the highest IV is. It's really with 1 day remaining, then the next week, then the next week, and then the following. So the weekly options, they're about 49-ish. Now, if we went to, let's say, 29 days to expiration, it's still at 46, okay? So what we're going to do in this case is we're going to look initially at the 21 November, okay? And we're going to look and see if is there anything. We cannot assume because there's 1.2 million shares that the options are liquid. We don't know. We're going to have to go look. Now, first thing I'm looking at right here is 50 cents, 60 cents. Seems wide. When we go look at the open interest, we see 30 contracts total in the world, not just here in Utah, okay? 10, 7. I mean, this is just nothing. The only thing that we actually see something on is the 95, the 90, and the 85. That's where there's the open interest. The open interest matters because you could actually be matched to one of the sellers if you're the buyer. If you're the buyer, you could be matched to the seller and vice versa. Seller to the buyer, buyer to the seller. So what I'm going to do is I'm going to go look down at December for just a second and see if there's any little tighter, any higher open interest. And lo and behold, 19 December with 57 days, there she is. 1,800, 4,600, 2,400. Now, is the spreads any better? 50 cents, 50 cents. There's one a little bit tighter, probably the tightest we've seen. Now, in this example, what I'm going to do is I'm going to show the November, and what I'm going to do just for time, what I'm going to do is I'm going to sell the put only. Now, remember, you sell the put only, it's a cash secured put. Okay? Now, if I click on that 95 right there, click on that, and we go to, let's say, the mid price 350, that 350 is upfront cash that's put into the paper money portfolio. It doesn't mean you made it yet. You collected it, and you're holding the other side of the stick. And the stick is really that the investor, it could be the buyer of the shares from now until expiration. What does the investor want? They want the stock to go up, burn time, volatility to go down, so the option price decreases in value, and where they might potentially miss the chance to buy the shares. They're just playing the option price, which is affected by price movement, time, and volatility. Now, confirm send. Now, James, you're not buying the put on this. That's true. If we don't buy the put on this, the risk is to 0. Okay? Now, that's why the max loss is 91.50. Okay? Break even 91.50 because it's the short strike less the premium. You got a max profit, max loss. Now, some people, they sell puts. They don't always buy the puts to the downside. I'm showing you this for a reason. Now, notice if we actually, if the risk is down to 0, the buying power effect, 91.50. Okay? Send. Okay? Now, if we went back just real quick and said, okay, we're looking at the Novembers. If we got, let's say, $3.50, what I like to kind of think about is, I like to look at 350 and say, that is what? I'm trying to find out what the percentage is. Well, if we got, let's say, a 350 premium and the stock price is at 97.95, tell me what the percentage is. Now, we could kind of do this with a dividend, okay? Let's say the dividend was $1 and the stock was 97.90, and I asked you a question like, well, what's the dividend yield? Well, you can figure it out. You don't need a PhD to know that. Well, this is dividend yield, DY, okay? What we're actually looking for over here is really OY, option yield, okay? So if I said, well, it's 350 divided by the current stock price, okay? Instead of dividend, we're looking option premium, 97.95. That's 3.5%, which is not completely shocking, given that there's more than 20 days expiration, given that the implied volatility is more than 35. Okay, not surprising. Does it mean it's better? No, it just means it's more volatile. That's why the premium is bigger. Okay. Now, what I'm going to do is let's go back to any other questions. Okay. Question is, what do you think about buying the complimentary put on a day that lower volatility so you can get a better bargain? Oh, well, so now we're starting to think. So you might be wondering, well, why didn't you buy the put below? Well, we know that the implied volatility has been higher. Noted. And so what's happening is all the puts that are out of the money, 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 they're also inflated. So Rita is actually saying, well, James, wonder if you got implied volatility that maybe drop down 5-10% or so, and maybe there's some liquidity on the open interest, etc. Bid-ask spreads are tighter. Could you maybe consider buying the put when that volatility compressed? Hello? Okay. Yes. So let's say fast forward in time. Let's say 5 days goes by, implied volatility goes down 10%. All of a sudden, these 80 puts, they're at like 20-cent bid, 40-cent ask, and you say, look, how do I buy the put? You click right on the ask price, and you're just buying a single option. That's it. And if we said, well, those option prices are now 30 cents because A, the volatility compressed, there's maybe a little bit more open interest, the bid-ask spread narrows in, and time went by, etc., and it kind of pushed down the option price, and I want to kind of make it where there's a downside protection. My gosh, now we're thinking. Okay, welcome to options. Okay, sure, great question. Now, whoever asked that, you're only allowed to ask, you're only allowed to ask one good question per session. Now, the question is from Dennis Davis 9602. Is this live right now? Of course, it's live. Anyway, yeah, we're live. Yes, welcome, Dennis. Okay, now, so here's what I want to also do. Let's go back to a couple of things that were kind of standing out here today. Now, a couple of stocks that were kind of standing out, they kind of had some unusual movement, okay? If we brought up the stocks for just a second, of course, if we're talking about stocks, why do we actually care about stocks? Now, we're talking about stocks on our feet, okay? We're talking about the semiconductor index. Now, why does it even matter? Well, this has been kind of a big catalyst for the market going up in general. Now, if the stocks is going up, why does it even matter? Well, because these are synonymous with growth names, right? NVIDIA's, LRCX, Micron, Texas Instruments, Intel, so on. This isn't the growth driver, okay? This could actually be kind of new technology in general. It could also be just existing like cars that need semiconductor chips. Now, if you take a look at this, if we kind of said, what type of price pattern do we really see on the chart? It kind of also has that ascending triangle. Now, we said before, my gosh, price patterns are awesome when it breaks out to the upside or the downside. But when we're inside this pattern, man, it exposes that I'm not patient, that I'm watching the profit loss for the day, I'm watching the account balance, and I'm really paying attention to not the trend, I'm paying attention to the P&L. We're not necessarily trading the trend, we're trading my account value. Now, tell me I'm not the only one that actually does that, okay? But sometimes to ride the trend, you really got to be watching the trend lines, the support levels, and say, look, am I still on the right side of support? Meaning the price is above it. Now, the reason why I bring up the stocks is when you take a look at a couple of these stocks, it's been interesting to kind of note LRCX, kind of an interesting push here. This is after the earnings. They had it yesterday. The stock gapped down, and then if we were to close here, this is actually showing close above the high of the low day. Now, what you're now going to notice is on this close above the high of the low day, you're now going to see that this has also been something where when we had earnings, the implied volatility is starting to drop. So after the earnings, where's the implied volatility tend to go? It tends to drop. Why? Because now what was unknown, earnings, becomes known. Now, the example that I want to do here is, let's imagine the investor says, James, I want to buy the shares. I've been waiting for the earnings section to pass. Here we are. I'm looking to see, can the stock stay up above a support level? The investor decides that they want to be long the shares of the stock, and they want, in this case, really be long these shares as long as the stock is really above 138. So if we take a look at this in this case, let's say the stock stays above 138, they want to be long, and now all of a sudden they say, look, I'm going to really be long and set a stop below the 138 threshold. So now, let's say the investor says, well, how do I know the stock's going to go up? Wonder if I want to kind of play that volatility, which is pushing up the option premiums. Now, one thing I want us to be I want to have us making sure that we understand. If we decide to sell the 150 and the premium is high, that actually might mean that the premium is, let's say, $3. Well, if the investor, let's say, gets up to 150 and, man, they get a $3 premium, they can make up to like 153, okay? Now, let's say the implied volatility goes down and they want to sell the 150. Well, are you expecting $3? I'm not. I'm probably expecting maybe 250. So what does that really mean? The investor makes up to 150, adds 250. They make up to 152.50. So notice that when we sold the pets, that when we had high premium, it was a lower break even. And the same thing, what you're going to notice when we do the covered calls, if the premium is high, it pushes up the cap gain. But when the volatility actually goes lower, it actually makes the premium lower and it lowers the cap gain. Now let's do this. We're going to do a cover call, okay? Now the reason why we're trying to really focus on these is if we kind of have more of a neutral market, that we're trying to push down the average price in which the investor owns the shares. Let's say the investor says in this case that they're going to buy the shares of stock, LRCX. Now, usually when you do something like a cover call and so on, you're trying not to commit forever. Why? Well, because you want to take the premium and run, so to say, meaning just be able to hold on to it. Well, let's say the investor says, look, step number one, we're going to buy the shares of the stock. Okay, click. Step number two, then what we're going to say is, well, which call? Where do we think the stock could stay below? Well, if we actually think the stock could stay below, I said 150. Let's say you said, James, I want to see maybe a little higher. This one, that one, this one, and so on. There's a couple there. So how do we do a cover call like by itself? I want to kind of take baby step, okay? So I'm going to click on the ask price, 147.49. Step number one is to buy the shares of stock. Step number two, we're going to go single order. First triggers SEQ. That just means first buy the shares first. Number two, then we're going to say, okay, which call we're going to sell. If we click on the bid price, we're going to sell the call. We click on the ask, we're going to buy the call. Cover call is we're buying the shares and selling the call. Well, let's say we come over here to, let's say, the 150. Let's go back to kind of what I was saying is this, what's the spread like? What's the open interest like? 25 cents there. If we go to this one, it's about 20 cents. If we go to the 155, it's 20 cents there. This is a little bit narrower and has more open interest. So I'm going to click on the 455. Now, are we going to take the 455 or are we going to try to squeeze a little bit more out of this? I think you know the answer. We're going to try to get in between that bid and ask, that 455 and the 475. And now what we're going to do in this case is we have a maximum gain. Now, the maximum gain is we get up to 155 plus the 465. Add those two together, it's like we're making up to, if at expiration, I'm talking about 155 plus 465, we're capped at 159.65. Now, I know this blows people's minds because they're like, you know, James, the stock was at 162 and I could have made more. You could always say that, okay? A lot of times you could say that, okay? We're kind of really looking at this and saying, statistically, what's the chances that the stock is, let's say, at 160-ish? Why did you say 160-ish? Well, because they don't have a 159.65 strike price. So if I went to the 160 and I said, statistically, what is the chances of the stock being above the maximum gain? Answer, as of right now, 29%. Does that tell us that there's a 71% chance at expiration the stock is below the maximum gain? We're playing the probability. So when people say, James, I'm not a math person, I always ask them, are you married? Yes. You did play the math. I don't know. I'm not following what you're saying. When you married he or she, you thought to yourself, probability-wise, what's the chance that he or she is going to be with me in 6 months, 1 year, if we have a family and so on? You definitely did the math because you thought to yourself, well, geez, what's the chances that he or she is going to be in my life? So you just haven't thought of it like this, but you did that math in your mind. You thought to yourself, what's the chances? And another way to say chances is probability, okay? Now, I did have a friend come up to me one time and he says, James, I'll be honest with you, I didn't think about that question. It didn't turn out that well, okay? And I said, sorry for the analogy. And I told him truthfully, I was very sorry that it didn't turn out right. But it would be a good question to ask next time. He goes, well, I'm actually remarried now. And since I asked that question, it's been a lot better now, okay? So we can learn from that, okay? Now, what you're now going to see is we're buying the shares and then we're selling the call. This is your classic cover call. Now, the movements we're actually seeing, okay, in this, we pull this up, it's not just LRCX. We're also seeing that same type of movement in AMAT, okay? Now, if you look at AMAT, we might even kind of say that that one kind of has that little diagonal. Now, remember, it's not diagonal. Diagonal, okay, with a Milwaukee accent. What you're now going to notice is it's getting a little bounce. Now, is this a piercing line? No, that kind of looks like a bullish engulfing candle on AMAT that's bouncing right off the diagonal line. We've been saying for about a week that we're also going to be watching CrowdStrike. Oh my gosh, lo and behold, what do we see here? Kind of has multiple handles, okay, that is actually on this. And if you look at this, a little run to the upside, there was a handle. There's another handle. Here's another handle. And so it's kind of interesting that it kind of created some sideways action right up near the area of resistance. Now, I don't have the time to actually do a trade on that because I want to show you some other ones. But that one might be where the investor says, hey, the MACD finally went green, showing us a little momentum with a little crossover on the moving average as well. Now, a couple others that I want to just kind of point out just quickly. The other one we said we're going to keep those eyes on, okay, is Zscaler. Zscaler is very similar to CrowdStrike. The difference is we just don't kind of have as many of those we don't have that short-term consolidation, the other resistance. But what we do see is when we look at this recent low, and what I'm going to do is I'm going to go back and kind of just play higher low dots. You see these dots right here? 1, 2, 3, 4, 5, 6, 7, 8. Now, I don't even know if that's right. Okay, I'm working on my Spanish and my Italian, but it's hard to remember every counting different languages. The reason why I kind of point these out is if I can kind of see those, could I kind of draw a line touching some of those green dots? Could those green dots be showing me where that diagonal line is? Could it also be showing me where the horizontal line is, if it was more of a horizontal support? Now, it sure looks like the reason why we talk about trading is because we've actually had this little up move and then down, up move and then down. Just because they go down doesn't mean we put our head down. We keep our eyes open for those trend lines that might act like support. Now, the one trade we're going to do just quickly is we're going to go back to, let's say, the Zscaler. And if I looked at Zscaler, let's say the investor said, James, I want to maybe just now the options. This classic example, I want to bring this up. Is everything liquid on the options? Of course not. Example given: 80 cents wide, $1.70 wide. So some of the examples you might say, James, I'm not going to do this as an option trade. It's not high volume. Now, in this example, what we're going to do is we're going to pull up Zscaler quickly. And what I'm going to do is I'm going to set a stop. I'm going to right click on the chart, buy custom, and what I'm going to do is going to go with stop. The stop is going to be underneath today's open price. Today's open price survey says 308. And if we set a stop below 308 less 2%, it's going to be 301.84. Okay? So now notice we've kind of done a cash secured put. We've done a short vertical. We did a cover call. And this one just being a classic stock example, okay? Now remember, the stop is if the shares are purchased, the stop becomes valid, and if it goes to that price, the key words are at that price or less, it could trigger to sell, okay? Now I'm going to tell you, if I could go back, people ask me sometimes, James, why do you hammer the message so hard? The reason why I hammer the message so hard, and I care more about you in the long term than offending you or hurting your feelings in the short term. If someone could have grabbed me, which no one did, okay, back in 1996. Now, by the way, I had dial-up AOL internet. Some of you don't even know what that is. That's a good thing, by the way. But the biggest actually thing is, if someone could have just knocked some sense into me, or another way to say it is just talk to me and logically pierce my brain, gosh, that would have been helpful, okay? The point I want to make here, and why I even brought this up, is a lot of times when stocks drop, I would put my head down, and then I said I like to get in at support. Well, you finally get the stock to go down to support, and you mentally checked out for a couple days. And then you come back. Where did you go? Where did I go? And then you said, dadgummit, if I was paying attention, I could have seen a nice support bounce right where we were just a couple days ago. Well, where did I go? Where did you go? Well, the market's pulling back and I just got busy doing other things. You want to kind of have that daily routine where you're always watching those levels, and when they go down, it becomes even more interesting to watch because those stocks might be on potential sale. They might be at where there's less potential risk because they're closer to support, okay? And there might be kind of more where there's more of an intermediate bounce on the stock, not just some short-term price momentum. Now, I'm out of my time here today, okay? But what I want to kind of do is show some variation. We did a cash secured put, we did a short put vertical, we did a cover call, and we did a stock position. All bullish examples here. Your job is to kind of go out and practice these bullish type of examples in the paper money account. Now, also remember with what we discussed, it was done for example illustrative purposes only. You can also go back to the live webcast and virtual workshop, and if you said, hey, what class is coming up next? The next class that's coming up next is going to be Short Verticals by Brett Crowther, okay? And you're also going to notice that we have other classes throughout the day, and Connie Hill, who is with us, the two redheads here, she will be actually also teaching selecting option strategies. So thank you so much for your comments and your participation. And I really do mean that. I'd rather kind of make someone maybe a little upset in the short term, and then they say thank you in the backside. And I'm trying to kind of just help you learn the lessons faster and not get kind of bogged down by mentality and mistakes that I made in my early on investing, which we didn't have any coaching, okay? So with that said, thank you so much for your comments and your participation. Stay tuned for Brett Crowther coming up next. Bye-bye.